Do you know that on July 4th, 2026, a new financial program launched in the United States that will permanently change how money flows into the stock market? And most people have no idea it exists? This is the story of Trump accounts, the structural shift that is quietly creating billions of dollars of new buying pressure in American equities every single year. And what it means for your money. This video is for educational and informational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions. Chapter 1. The Announcement. On July 4th, 2026, the United States government began seeding investment accounts for American children. Under a federal program called Trump Accounts, every child born between January 1st, 2025 and December 31st, 2028 is eligible for a $1,000 government contribution. The money can only be invested in low-fee broad US equity index funds, funds that track the S&P 500 or the total US stock market. This is not a savings account. It is not a bond. It is not cash. It is equity ownership in American companies, mandated by law, beginning at birth. As of late May 2026, nearly 6 million children had been enrolled in the program, roughly 40% of all eligible children. And on launch day, the money began to flow. Chapter 2. The scale numbers like $1,000 per child can seem modest in isolation. But when you multiply that number by the scale of the program, it becomes something different. Bloomberg Intelligence estimated the initial annual flow at approximately $12 billion. That is $12 billion that must, by law, be invested in US equity index funds. Not bonds, not foreign stocks, not real estate investment trusts. US equities only. If households contribute additional money above the government seed, which they are encouraged to do under the program, that annual figure rises toward $21 billion. To put that in context, the S&P 500 has a total market capitalization of approximately $55 trillion. $12 billion is not a large percentage of that, but $12 billion arriving on a predictable, mandatory schedule every year, regardless of market conditions, is structurally different from discretionary investment. It creates a permanent bid, a structural flaw. This is not unlike what happened with 401k plans in the 1980s and 1990s. When American companies shifted from defined benefit pension plans to defined contribution 401k plans, they created a new class of mandatory equity buyer, the salaried worker whose contributions went into stock funds every pay cycle, whether the market was up or down. The effect on markets over the following decades was significant. Trump accounts have the potential to create a similar structural effect at the earliest stage of life. Chapter 3. Who benefits? When $12 billion must be invested in US equity index funds, the question is not whether markets benefit. The question is who captures those inflows. The answer, at this scale, is the index fund industry. Vanguard, BlackRock, and State Street manage the three largest US equity index fund families in the world. Their flagship products, the S&P 500 Index Fund and the Total Market Index Fund, are the natural landing point for Trump account money. These companies are not equal beneficiaries. The flows will concentrate in the lowest fee options, which means Vanguard has structural advantages given its mutual ownership structure and historically lowest expense ratios. But every major index fund provider benefits, and through them, every company in the S&P 500, because every dollar that flows into an S&P 500 index fund is distributed proportionally across all 500 companies in the index, weighted by market capitalization. The biggest companies in the S&P 500, Apple, Microsoft, Nvidia, Amazon, Alphabet, receive the largest proportional inflow from every Trump account dollar. This is a mathematical consequence of market cap weighting. Michael Dell and Dell Technologies pledged $6.25 billion in philanthropic contributions to seed Trump accounts for lower-income families. $250 from Dell, matched by the federal $1,000, giving lower-income children $1,250 to start. This is philanthropy with a market mechanism. The money flows into index funds and permanently joins the stock market. Chapter 4. The Political Economy. Trump accounts are not simply an investment program. They are an attempt to change the political economy of stock market ownership in the United States. As of early 2026, roughly 60% of American households owned equities in some form, through pension funds, 401k plans, or direct investment. But that ownership is deeply unequal. The top 10% of Americans by wealth own approximately 93% of the equities held by the household sector. For the bottom 50%, stock market ownership is largely theoretical. Trump accounts are designed to change that. If 38% of American families are entering the stock market for the first time through this program, as one analysis suggested, then the program is doing something more significant than creating buying pressure. It is creating a new constituency of equity owners. People who own stock behave differently in elections than people who do not. They think differently about market regulation. They pay attention to different things. This is the long game. A child who receives a Trump account at birth, who watches that account grow over the next 18 years, who comes of age with the habit of equity ownership already embedded, that person relates to financial markets differently than their parents did. Whether that is a desirable political outcome depends on where you stand. But it is an outcome that the program's architects clearly understood they were creating. Chapter 5. The Risks. No financial program is without risk, and Trump accounts have several worth examining clearly. The first risk is concentration. By mandating that all money goes into US equity index funds, the program creates no geographic diversification. If US markets underperform global markets over the next 18 years, which has happened in previous periods, Trump account holders will underperform a globally diversified investor. The program's designers made a deliberate choice to create US-only equity exposure, which is a bet on American exceptionalism that may or may not pay off. The second risk is timing. For children born in 2025, their accounts will become accessible in approximately 2043. No one knows what the market will look like in 2043. It may be significantly higher. It may have experienced one or more major crashes. The mandatory long horizon is both the program's greatest strength. Time in market is the most reliable predictor of equity returns, and its greatest uncertainty. The third risk is political continuity. A program created by one administration can be modified or eliminated by a subsequent administration. Trump accounts as they exist today require ongoing political support to maintain their current structure. Future changes to tax treatment, contribution limits, or investment rules could significantly alter the program's value. The fourth risk, perhaps the most subtle, is the feedback loop. When a large, predictable flow of money is mandated to enter a specific market at regular intervals, it can inflate the prices of the assets in that market beyond what fundamentals would justify. This has been observed in other contexts. If Trump account inflows create artificial price support for US equities, they may be building a valuation premium that will eventually correct. Chapter 6. What to watch. The Trump account program represents a genuine structural change in how money flows to US equity markets. For investors thinking about the medium to long term, there are several things worth monitoring. First, the adoption rate. 6 million children enrolled by late May means 40% adoption. If that rises toward 80 or 90%, the annual inflow numbers rise proportionally. Higher adoption means more structural buying pressure. Second, the political environment. Any significant change to the program, in either direction, would alter its market impact. Expansion of the program to older children or adults would accelerate inflows. Restriction or elimination would remove them. Third, the index fund industry's response. As Trump account money concentrates in a small number of funds, those funds gain proportionally more voting power at shareholder meetings. The governance implications of the index fund industry, holding an even larger share of American corporate ownership, are significant and not yet fully understood. Fourth, how the program interacts with the Federal Reserve's current posture. At the moment Trump accounts launch, the Fed is signaling rate hikes. Rising interest rates tend to suppress equity valuations in the short term. The mandatory buying pressure from Trump accounts may partially offset that headwind, or it may simply mean that the money flows in at lower prices, which benefits long-term returns for the account holders. Trump accounts are new. Their long-term effects are uncertain. What is certain is that they represent a deliberate, government-mandated intervention in the structure of the equity market. That is historically unusual. It is worth paying attention to. Remember, this video is for educational purposes only and is not financial advice. Before making any investment decisions, consult a qualified financial advisor who understands your personal situation.